Good morning, everybody. I'm Chuck Hughes, and welcome to the Traders Forum. It's great to be here today. I have a lot of exciting information to share with you. Now, I'm sure you're all aware of the increased market volatility over the last couple months. But with that increased market volatility comes some great trading opportunities. That's why I'm so excited today to be presenting my global Powertrend system, or GPS. GPS trades global currencies, commodities, and equities. It's a trend-following system that identifies major trends in these global markets. There's never been a better time to trade these markets than now. And Global Powertrend has produced record profits for my advisory service members. And it's taken full advantage of the recent market volatility. Now, one of the big advantages of Global Powertrend is that it's not correlated with the U.S. stock market. It's been really painful to watch the decline in the market. It's down over 40% over the last year, and a lot of investors have been hurt. And the other advantage of Global Powertrend is that it takes short positions as well as long positions. So the goal is to trade a diversified portfolio of global markets, both long and short trades. Now, GPS is a trend-following system and allows us to trade with the trend instead of trying to predict the trend. Now, this has been really important lately because people have been trying to pick a bottom in the markets for a while now. They just seem to keep going down. So if you stay with the trend, right now is a good time to be a trend follower. GPS only allows trades in the direction of the major trend, and we'll find out how to identify that here shortly. A bullish trade is taken only if the major trend is bullish. Of course, a bearish trade is only taken if the major trend is bearish. Now, trading in the direction of the major trend helps prevent whipsaw trades when the short-term counter-trend rallies or sell-offs occur. And preventing whipsaw trades can increase profits, reduce losses, and increase the percentage of winning trades. And I have a few graphs here of U.S. stocks over the last couple months, and you can see how volatile they've been, up, down, up, down, up, down, up, down. So in contrast to some of the global markets, which have more consistent trends, I think. This is a 1-month chart of the euro currency over a several-year period, and you can see there's an uptrend there and then a clearly defined downtrend. The global power trend is taking advantages of these more consistent trends in global markets. Here's a graph of the emerging markets ETF, and again you can see the consistent uptrend followed by a consistent downtrend. This is the iShares Brazil ETF. Here's a few more examples. The materials Select Spider, Latin American ETF. Again, another clearly defined uptrend followed by a clearly defined downtrend. iShares Germany. So those are a few examples of the global markets I've been trading. GPS uses ETFs to trade all these various markets. As you probably know, ETFs are portfolios of stocks, bonds, currencies, or commodities that trade as a single stock on the stock exchange. And ETFs have been around since 1993, and they've really gained popularity over the last several years. Now, there's over 700 ETFs that track just every imaginable market or sector that you want to trade. So there's a wide variety of markets to trade with ETFs. Here's some examples of currency ETFs: Australian dollar, British pound, Canadian dollar, euro currency, Japanese yen. So there's quite a wide variety. This is just a few examples. Here's some of the commodity ETFs, also a big selection of commodity ETFs, everything from grains to oil to silver. So there's a lot of trading opportunities with these ETFs. Here's some of the equity ETFs from around the world, and these have been great to trade lately. Now, I've been trading ETFs almost since the inception with my seasonal and cycle systems. I have many years' experience trading these ETFs, so I wanted to list just a few of the advantages that I've experienced. It allows us to invest in the global currency, commodity, and equity markets that have the greatest profit potential. And it allows you to diversify your investments across a wide range of asset classes. And they allow you to trade from the long or short side, which increases the profit opportunities and reduces the market risk of owning individual stocks. And I'll show you an example of that here in a minute. All of the GPS trades are limited risk trades, and we'll go into that in a little more detail too. They can help you achieve the GPS goal of a 3-to-1 profit to loss ratio. Now, individual stocks are always susceptible to market risk with unfavorable news or earnings reports. And I have an example here. Bristol Myers stock, you can see they had a bad earnings report, and the stock went down pretty hard here in a very short period of time. Now, Bristol Myers is part of the pharmaceutical ETF holders, and this chart shows the pharmaceutical holders over the same time period, and you can see that it went on to make a new high, even though Bristol Myers suffered a severe loss there in a short period of time. So the ETFs can help eliminate the risk associated with a specific stock. Now, all of the GPS strategies are limited risk strategies, and the most you can lose is your initial investment. Regardless of adverse moves, you can't lose more than you invest. And you won't receive a margin call from your broker or be asked to add funds to your brokerage account. Now, this is really important today because of the volatile market. Here are the GPS strategies. We have a call and a put option purchase strategy, a call and put option spread strategy, bearish ETF fund purchases, and covered calls. These markets, of course, are not limited risk, and you can lose more money than you invest. You can get a margin call, you can be forced to liquidate, and with the way the markets are today, I don't think that's a good position to be in, because with the overnight news, your account could be wiped out with a very small adverse market move. The futures trading usually involves 10-to-1 or 20-to-1 leverage. The Forex trading can be 100-to-1 or even 200-to-1. It only takes a small adverse move to have your account wiped out, and you're going to wind up owing money. And I know people that's happened to. The recent collapse of Lehman Brothers and Bear Stearns and AIG was not because there's a 5% default rate in mortgages in the U.S. It's because they were so highly leveraged. They violated this number one rule of trading here of never putting yourself in a position to lose more money than you invest. So they violated that rule. 40-to-1 leverage, you only need a 2 or 3% adverse move and you're wiped out. So that's what caused the collapse of these companies, not the fact that there's a 5% mortgage default rate. Now, the way we identify the major price trend with GPS, 1 month price in relation to its 20-month exponential moving average. That is a good way to define the major trend. Now, if the 1 month price is above the 20-month exponential moving average, then a major bullish trend is indicated. And of course, if the 1 month price is below the 20-month EMA, then a bearish major trend is indicated. So this simple system has been very effective in identifying the major trends. And again, with the 1 month price above the 20-month EMA, we get a buy signal. And with the 1 month price below the 20-month EMA, we get a sell signal. Very simple system, but very effective. Now you can download the 1 month, 20-month EMA price charts from stockcharts.com with their basic service. I think it's $14.95 a month. So now I've got a price chart here of the emerging markets ETF. We can see from 2004, this was the inception of the ETF, and since 2004, it's been in a major price uptrend. This is the monthly price right here, and the steadier line right here, that's the 20-month EMA. So the 1 month has been above the 20-month EMA, and we can see that it's been in a bull market for several years. In June of this year, the 1 month crossed below the 20-month EMA, indicating a sell signal, and short position should be taken. So a very simple system to identify the major trend. Now I also have a 10-year chart. This is a longer-term chart. Most ETFs were created in the last 5 or 6 years or so there's limited historical data. But this is a 10-year chart of the S&P. And again, this is the 1-month price right here, and the smoother blue line right here is the 20-month EMA. Major trend in the late 1990s was up, and then in October of 2000, the 1-month price crossed below the 20-month price. That was right in the beginning of the bear market there, and it stayed bearish May of 2003. The 1-month crossed above the 20-month EMA, and we went into a major bullish trend until December of 2007, right here. The 1-month price crossed below the 20-month, and we got a sell signal, and you can see that was a pretty good sell signal right there. So the system's been riding this down market, well, in the case of the S&P, since December of 2007. Yeah, question?
On this, would you advocate going short the market when it's below the EMA?
Yes. Yeah, the question is, do I recommend going short the market when the major trend is bearish? And yes, that's the whole idea. You can see if you went short here, that was a good point to go short. And of course, if you went short here, that's a good point to go short. So yes, we do go short, but with ETFs, you don't have to short sell like you do a stock. You can buy a bearish ETF, and I'll show you an example of that. So again, it's limited risk. If you buy a bearish ETF, that's a limited risk strategy. And I have a profit graph here. The profits you would have realized trading the GPS system on the S&P, and this goes back 10 years. This covers the same period as the chart I just had up there, 1998 to 2008. Now, the S&P has actually had a negative return of about 15% over this 10-year period. But because GPS goes short, if you invested $10,000 in 1998, 10 years ago, with GPS, it produced about a $29,000, well, $10,000 grew to $29,000, and after you deduct your initial investment, that's about a 190% return over that same 10-year period that the S&P actually lost 15%. This is of the emerging market ETF. The emerging market ETF has declined 56% from a year ago when it hit a high price. The ETF is now actually down 28% over the last 2 years. So here's a 2-year price chart. What I did is I calculated the profits over this same 2-year period with trading with GPS. A $10,000 investment grew to $20,000. So we had about 100% return over a 2-year period compared to the actual ETF. If you were buy and hold and you bought the ETF and held it for 2 years, you would have had a 28% loss. So being able to go short makes a dramatic difference, as you can see, the system. GPS Major Trend System, which is the 1-month, 20-month EMA system, it's a rule-based system with clearly defined buy and sell rules which allow for historical testing. The historical profit results are based on closing out bearish ETFs and buying a bullish ETF when the 1-month price crosses above the 20-month EMA, and closing out bullish ETFs and buying bearish ETFs when the 1-month price crosses below the 20-month EMA. I conducted historical profit testing on a diversified portfolio of 8 global markets, including crude oil, the euro currency, bonds, and equities. And here's the 8 markets that I tested. That's a pretty broad cross-section there. You got crude oil, emerging market, Latin America, Europe, euro currency, 20-year treasury bonds, the Brazil index, and the S&P 500 index. So it's a broad cross-section of global markets. Historical results that follow, they're based on an investment of $10,000 divided equally among these 8 global markets in 1995 or since the ETF inception. And we compound the results thereafter, and they don't include commissions. And the historical results do not reflect the use of any type of leverage. Our initial $10,000 investment grew to $121,000, so we had $111,000 profit over that period. It's about 13 and 3/4 years was the total testing period, almost 14 years. So the total return over that period was 1,100%. The average annual return was about 80%. The total profits over that period was $113,000, and the total losses were only $2,500. So that gives us a profit to loss ratio of 45-1. The goal of GPS is a 3-to-1 profit to loss ratio. So this, of course, far exceeded it. And here's a graph of the growth of $10,000. So now when we have a high profit to loss ratio, what that means is the system exits losing trades before they develop into big losers. And that's really important. And that's a good measure of the risk of a system, is the profit factor, or the profit to loss ratio. And of course, the higher the number, the better. And if you have a high profit to loss ratio, that means that your system is exiting losing trades before they develop into big winners and riding the winning trades. Now, during this 14-year period, there were two global bear markets, two severe bear markets that occurred during this testing period. The profit results demonstrate that the major trend system is a very versatile and effective method for profiting in almost any type of market. All of the years were profitable, even during the two bear market years over the testing period. One of the great advantages, again, of the GPS system is that you can also diversify your portfolio by asset class, which reduces risk and can increase returns. And also the big advantage is it takes both long and short trades, which that dramatically increases your profit opportunities. Now, what I listed here were the profit results for the individual markets. This is the emerging market ETF since inception, which has been about a 5-year period. Total return was 300%. Average return of about 60%, and there were no losing trades. Here's the S&P 500 index, Euro currency, Brazil ETF, crude oil, Latin America. And again, you can see with the Latin America, there were no losing trades, so there were no losses with following the GPS system with Latin America. This is the 20-year Treasury bond ETF results here. So you can see that the system works in a wide variety of markets. It's not custom fit to any particular market. It works in all markets, including individual stocks. When the GPS system issues a major trend buy signal, there's 4 types of bullish trades we can take. We can purchase an ETF. We can purchase a call option. We can do a covered call, or we can do a bullish option spread. And I'll show you actual examples of those here in a minute. And when the system issues a sell signal, we can purchase a short ETF, we could purchase a put option, or we could do a bearish option spread. The GPS does not sell short like you sell short a stock, which is a high-risk strategy. Instead, you purchase a bearish ETF, which is a limited risk strategy. Now here's an example of a system issuing a sell signal in the emerging market ETF, which is the symbol EEM. This is a copy of my brokerage statement. Now the short ETF for the emerging market index is the EEV, and you can see I bought 600 shares of that at an average price of 101.98. I think that's trading now around 180 or so. And of course, the short emerging market ETF is inverse to the emerging market ETF in that if the emerging market ETF is increasing, then the short ETF, of course, is decreasing in price. If the emerging market ETF is declining in price, then the short ETF is increasing in price. So it's just the opposite or inverse to owning the ETF. So it's a way to take a short position without actually shorting any stock. I purchased the short ETF after the 1 month price dropped below the 20-month EMA. The question is, what do I use for a stop loss? And the system doesn't use a stop per se. It is stopped out when it reverses to the other side. But I'm going to show you a shorter term system that we can use to exit. It's shorter term than the 1 month and the 20-month EMA.
Those using the ultras on the short side, do you normally use those or just the straight short?
Yeah, the question is, with the short ETFs, this is an example of the ultra right here, which is 2 times the inverse of the ETF versus the short ETF, which is 1 time the inverse. And the ultra gives you a double leverage. And I normally use the ultra funds because it gives me double leverage, but it's double the risk too. So that depends on your risk tolerance. If you have a high risk tolerance, you can do the ultra short, or if you don't have a high risk tolerance, you can do the short. Now, what I did was I also listed some buy signals I took last year on these 4 markets here when they were in a major trend bull signal with the 1 month price above the 20-month EMA. So this is the iShares Global Energy Sector Brazil Fund, Europe, Australia, and Far East. And again, I'm going to show you examples here where I went long when it was bullish. Of course, it's bearish now. And this is the Builders Emerging Market Index. So these are examples of buy signals in those 4 markets plus other markets that I took when they were in a bullish mode. And some of these are just call purchases, and then some are bullish option spread where you buy a call option and then you sell a call option with a higher strike price. So those are 2 examples of bullish trades. Covered calls too with the GPS system. If it's in a bullish mode, if the market's in a bullish mode, you can write a covered call. And normally with a covered call, one call option is sold for each 100 shares of stock that's purchased. 2 main objectives of the covered call is to generate income from the sale of the call option and also to provide downside protection in the event the ETF declines in price. Now here's an example of a covered call. I purchased 300 shares here. It's in 3 different trades here, but I purchased 300 shares of the short emerging market ETF on August 29th, and then at a later date, September 12th, about 2 weeks later, I sold 3 call options, the short emerging market ETF. So this is essentially a covered call, buying 300 shares and selling 3 call options. Here's a covered call analysis of buying the stock at 96.80 and selling 3 of the 120 strike call options at 20 points. That's what the brokerage account indicated. So I input those into my software, and the break even on this would be 76.80. So the short emerging market index ETF would have to drop to 76 before that would lose money. I think that's trading around 170 now, 180. What this analysis does is it looks at the profit from this covered call, assuming various changes in the EEV stock at option expiration. ETF increases 25% in price from the 96.80 purchase price. The stock price would be 121. We'd have a gain on the stock. Net profit for each covered call would be $4,300, and it'd be about a 56% return. And if the stock stayed flat, you can see we'd still have a positive return, 26% positive return if it stays at 96.80. If the stock declines 15% to 82.28, we would still show a profit for the covered call. So the covered call presents good profit opportunity and also gives you downside protection. So that's one of my favorite strategies.
How far out you can go?
The question is, how far out did I go out on the covered call? I sold the call in September, and I believe the expiration date was March on that. So I went out about 6 months on that.
In your notes, it said you sold in December 08.
Oh, okay. Okay, yeah, so September to December, that's a three-month trade. Thank you. Yeah, that's all based on a 3-month trade, September to December. So that's a pretty good return. 56% profit potential over 3 months, I think, is pretty good, and also gives you downside protection. Now, another strategy I've been implementing lately is writing leaps covered calls, where you purchase a stock and sell a leaps call option. I will write these leaps covered calls even if the stock is not in a major trend up signal or bull signal, because you get so much downside protection from the leaps call option that you don't have to be, it's not that critical that you're right about the timing of when you enter these. In other words, this is a long-term trend. The leaps covered call can provide substantial downside, also substantial upside. So I've been writing a lot of these lately, and here's an example one I just did last week, actually. And I bought 100 shares of the Brazil index at 33.69, and then I sold the January 10 40 strike leaps option at 7 points. So that's about a 15-month trade. And the options right now are providing a very rich premium. You can get a pretty good return and pretty good downside protection. This is the Brazil index. I bought the stock, the ETF stock, at 33.69 and sold the January 10 40 strike call at 7.10. So the break even on this is 26.59. So the ETF would have to drop to 26 before a loss would be incurred, and I've got 15 months for this ETF to go up. Actually, if it stays flat, it still makes a profit even if it stays flat, just where it is now. If the ETF goes up 20% between now and option expiration, this will make a 50% return. If it stays flat, then you get a 26% return, and if it goes down 20%, you just about break even on the trade. So that's a pretty low risk trade. So again, a 20% increase in the ETF price would result in a 50% return, and a flat ETF price would be a 26% return, and you have down more than 20% of downside protection. Now I'm going to show you an example of a bearish option spread that I took, and this is on the Russia ETF. I bought the November 08, which is next month. I bought the 50 strike put options on August 26th at 14.50. Now these put options, of course, they profit if the Russia ETF goes down in price. And the Russia ETF was on a GPS major trend sell signal. Here's the buy of the Russia ETF 40 strike put. Yeah, it was a total of 10 that I purchased right here. I then sold 10 of the November 45 strike puts on September 9th. So that was less than 2 weeks later. I sold the 45 strike put for 13.6 points. Now when you do a bearish option spread, you want to buy a put and sell a put with a lower strike price. So the analysis I'm going to show you here shows the risk-reward profile for buying the 50 strike put at 14.50 and selling the 45 strike put at 13.60. The cost of this spread was only $90, 0.9 points or $90. That's because I bought the put for 14.50 and sold one for 13.60. So the difference between the buy and the sell, 0.9 points. Once you do that, of course, it makes it a very low risk trade. If the Russia ETF goes down 30%, you still make the full profit potential. If the ETF is flat, you still make the full profit potential, which is 455% in this case. And if the Russia ETF goes up 30%, to 46, you still make the maximum profit potential. And the Russia ETF right now is selling at about 15. The spread trades allow you to reduce your risk from your initial put option purchase by selling a put option with a lower strike price. And again, the maximum risk for this spread trade was the cost of the spread, which was $90 in this example. Now, there's a way to enhance our returns using the 2 beta funds, whether they're bullish or bearish. There's a lot of these 2 beta funds available. So if you get a buy signal in an ETF, you can buy the 2 beta ETF. And if you get a sell signal, you can buy the 2 beta short ETF. So, of course, that is going to increase your returns. It also increases your risk. So here's an example of some of the 2 beta funds that are available. They use leverage to increase your returns. But buying these funds, it's still a limited risk trade. You can only lose what you invest. So even though the fund uses leverage, there's still a limited risk trade. So here's an example of using the GPS system for buy and sell signals for the emerging market ETF. But instead of buying the ETF, you buy the double beta ETF. And when you get a sell signal, you buy the double beta short ETF. And here's the return over a 5-year period. The returns, it produced a $72,000 profit. Total return over 5 years was 700%. And the average annual return was about 145%. The double beta funds obviously increase your return, but that comes with more risk. And here's a profit graph of the using the double beta emerging market ETFs from 2003 to 2008. Here's an example of using the double beta for the S&P 500 index. Over the last 5 years, it produced a $15,000 profit, total return of 160%, annual return of 32%. And here's an example of the growth of a $10,000 investment using the enhanced funds or double beta funds versus the 1 beta ETFs. Now, with the GPS system, if you get a buy signal, you can also purchase a call option. If you get a sell signal, you can purchase a put option. And what I did here was I'm going to show you some examples of call options I purchased and then compare that, the holding period of the call option, compare that return to buying the ETF itself. So I'm comparing the return of the option versus the return of the ETF. In 2006, I bought this is the emerging market call, the June call option right here at 14.20. And then I sold the call about 6 months later on June 14th. And purchased the call at 14.20. 6 months later, I sold it at 29.30. And that was a $7,500 profit after commissions. That works out to be about 106% return. Now, what I want to do is compare that to buying the ETF itself over the same time period, just to show you the leverage that options provide. Here's the closeout of the 5 options 6 months later. Over the same time period, when I purchased the call option on December 12th of 2006, the ETF was trading at 111.30. And then 6 months later, when I closed out the call option, the ETF was trading at 129.20. So that's about a 16% return for the ETF. And over the same period, the option had 106% return. So that's about a 6-to-1 leverage. Actually, it's 6.6-to-1 leverage. So the options, in this case, provided leverage that was better than 6-to-1. A question?
If this is a long-term system, why would you only buy 6-month options?
The question is, if it's a long-term system, why would I only buy the 6-month options? When it comes to buying calls or puts, I usually go 6 months out. You don't know when if the system's going to turn short over that period, so you just have to pick a time frame And I usually go either 3 months or 6 months out if it's just a straight call purchase or a put purchase. Because you don't know when, you don't want to buy a leaps option because you don't know when the system is going to go bearish. Okay, so with the 6-to-1 leverage, again, if you just purchased the ETF, you'd have about a 16% profit. It would have been a big investment, $11,000 to buy 100 shares, and you have a modest profit. But with the call option, your investment is much lower and your return is much higher due to the leverage that the options provide. Now here's a couple more examples. For the Brazil index, I purchased 10 of the call options, and this is the emerging market builders ETF here. I purchased 10 of those. And here's the profits I realized on the options. And over the same time frame, the Brazil ETF produced a 14% return, and the option produced an 82% return. And the Builders Emerging Market Index, the ETF had about a 16% return versus 103% return for the option. So the average of these 3 trades was about 6.2 to 1 leverage. So now what I'm going to do is I'm going to project this and do historical testing for some ETFs based on 6-to-1 leverage. In other words, you're buying the call option or a put option instead of the ETF itself or a short ETF. So I want to just compare the returns if you're using 6-to-1 leverage versus just purchasing the ETF. Now this is just theoretical because some of these didn't have options available when I started the testing. So these are just theoretical results. And what I did is I did the option testing on those same 8 markets that I presented in the beginning there, the diversified global portfolio. So again, it's the crude oil, emerging market index, Latin America, Europe, euro currency, 20-year treasury bonds, Brazil, and the S&P 500 index. The results are based on investing $10,000 at the beginning of the test period and compounding the results thereafter, and they don't include commissions. And you can see that that dramatically increases the profit potential when you use the 6-to-1 leverage. This first example is the emerging market, $10,000 investment. Since the inception of the fund, which was 5 years ago, produced $365,000 profit, a total return of 3,600%, average annual return of 700%. There were no losing trades. So you can see that obviously using the options with leverage is going to increase your returns dramatically. Here's the S&P 500 index. $10,000 investment in the S&P produces a $1 million profit. And here's the other markets. So using options with the leverage, you're going to get a big return, and it also increases the risk. But if you're taking these trades with the major trend, that puts the odds in your favor, and you can get a very good return, as demonstrated by my brokerage statements and the trades that I closed out. Question?
Earlier you mentioned that you use a stockchart.com to identify the moving average change or whatever to identify the opportunity, right?
Yes.
And then you would use option analysis. You have a put option analysis, spread analysis for the Russian stock RSX.
Yes.
And where you have basically no risk of trade, which seems to be that if the stock drops, 30% or stays flat or up 30%, you will still make maximum return, which is 450%.
Right.
Return, right?
Right.
The first question is, what software do you use to do the analysis?
The question is, which software do I use to do the spread option analysis? I created software that does all the analysis for these various trades, whether it's a call option purchase, put option purchase, spread, covered call. I develop software for all these strategies, and that's available with my home study course, the software. Those are online calculators that you can go online and type in the strike price, the stock price, and the premium, and it'll give you that analysis.
Okay. The second question is, how often do you can identify such trades where basically there's no risk, virtually no risk? You have a maximum of $90 of loss.
Yeah, the question is, how often can you identify these trades that have almost no risk? And it varies. Right now, obviously all the put options I purchased are in that category because the market's gone in my favor. And last year, it was just the opposite. I showed my brokerage statement from last year and the year before, and that had call option spreads. So last year, I was able to do call option spreads with virtually no risk. This year, it's put option spreads, but there's no way to predict how often or how many of those trades you're going to get. It all depends if the trend goes in your favor.
Would you describe this as maybe one of the best scenario you have, or do you have some better ones that have high return and virtually no risk?
The question is, do I consider this the best strategy? And I would say yes. The option spreads are probably the best strategy for reducing risk and increasing your returns, because when you buy a call and sell a call, and you sell the call for almost the price that you paid to purchase the call, it removes most of your risk. And it also increases the profit potential because the call that you sell has time value, and it actually increases your return by creating the spread. So not only do you reduce your risk to almost zero, but you also increase the potential of the long option by selling an option because of the time value. Now, I make trading recommendations for the major trend system through my GPS advisory service. And I just want to show you some of the recent results just to see how the system has been doing lately. I recommend trades in all the strategies that I listed, the call and the put option purchase, the call and the put option spreads, and the covered calls, and buying the bearish ETFs. So I make recommendations for all those strategies with my service, and I just wanted to give you an idea of the recent results. This is as of October 7th, and you can see the first trade listed here is Australian dollar option spread. I bought the put option at 15.40, sold a put option with a lower strike at 13.20. These are all based on a $10,000 investment in each recommendation. Now, of course, if you only do one contract, then it's a much lower requirement. In this case, it would be this spread only cost $220, because if you paid $15.40 for the option and you sold a put with a lower strike at $13.20, then your total cost is $220. So obviously, if you just do one contract, it's a lot less initial capital requirement. In this first example, the Australian dollar puts have about an $800 profit, a 95% gain, and the short puts, they have about a $4,300 loss, but the net result of the spread, that has about a $4,500 open trade profit right now. Here's a British pound spread trade right here, euro currency, and these are examples of put option purchases for the euro, the Australian, and this is the short euro fund. This is an ETF this is not a double beta ETF. This is just a one-to-one short euro that I recommended at $40. It's currently trading at 50. It's actually much higher than that right now because the euro has been falling against the dollar. And here's a British pound put option trade example there. So as of October 7th, the total profit was $45,000, and it had about 102% return. And here's an example of the commodity portfolio. And again, this consists of option spreads, option purchases, and here's the short materials fund right here. That's an ETF. Bought that at 37. Right now that's trading at 80, so that has about 115% return for just the ETF. So you can see that covers a pretty wide range of different types of commodities. And this portfolio, as of October 7th, had a $96,000 profit and an average return of 204%. And here's the equity portfolio. And again, we have option spreads as well as ETF purchases. That's an ETF short emerging market ETF purchase right there. The equity portfolio had about $138,000 open trade profit and about a 200% return, average return. So this just gives you an idea of the recent results of the system. It's been doing well because the major trend's been down, and it caught the beginning of the major trend down. Yes?
Holding those since the beginning of the year?
No, these are all different holding periods. Most of these were initiated over the summer when the markets started to trend down. Did everybody get that question? He was asking about the holding period. Most of the markets went into a downtrend over the summertime, so that's when these trades were initiated. Except for the dollar, the system's been long the dollar index and short the foreign currencies right now. And here's some closed trade results for September. Now this includes all three portfolios, the equity, the commodity, and the currency. Closed trade results for September are around $45,000, average return of 122%. And for October, these are the closed trades, about $109,000 profit, 216% average return for October. I'm also presenting the GPS short-term trend system. With the short-term trend system, we use the 50-day and 100-day EMA in conjunction with the 1-month and 20-month EMA. So we use those together. We use the 1-month and the 20-month EMA to define the major trend, and then we use the 50 and 100-day to define the short-term trend. Yes, question?
When you say you use the 1-month price, are you looking at today's closing price every day until it crosses or doesn't cross the rolling 20-month EMA? Or do you just look at that at the end of every month? Or are you using the 1-month standard moving average crossing the 20-month?
Yeah, the question is on what do we use for the 1 month? Is it a daily price, or is it the price at the end of the month, or is it a moving average? It's not a moving average, it's the monthly price. And what I do is I look at the price at the end of the month, the last trading day of the month, and that's what I use for the monthly price. So if that, at the end of the month, if that price is above the 20-month EMA, then we're on a buy signal. If that 1-month price is below the 20-month EMA, we're on a sell signal. Now the 50-day and 100-day EMA, that can be downloaded from a number of websites, including Yahoo Finance. I use Yahoo Finance, and you can just select the 50-day and 100-day EMA, and it'll display the chart for you. So what I do with the short-term trend system is I use the 1-month and 20-month as an entry filter that only allows trades in the direction of the major trend. So with the short-term trend system, a bullish trade is taken only if the short term, which is the 50 and 100-day EMA, and the major trend are both bullish at the same time. And with a bearish trade, you only take a bearish trade if the short term and the major trends are both bearish at the same time.
Just for clarification, the 1 month price, you take that as the end of a month's closing price?
Yes. Again, the 1 month price is the price of the ETF on the last trading day of the month. Now, what this allows us to do, the sell signal, or the short-term system, is to trade on a shorter-term basis because the major trend sometimes will go for several years and it won't change. So the short-term system allows us to get in and out at a more frequent time interval. So, of course, if you're trading with a shorter-term system, timing is everything, and you want to invest with the trend, not only the short-term trend, but you want to invest with the major trend also. Yes?
Hi, where you have the 50 EMAs above the 100 EMA, and then under it in the little box you have 1 month is above the 20. Are those equal? Were you just converting them for us, or is there's 4 things that you're looking at?
No, the question is the 50-day and 100-day the same as the 1 month and 20-month EMA? And no, they're totally different. So you're actually looking at 2 different charts, 2 different price charts. One to determine the short-term trend, the other to determine the major trend. So now, of course, there's a direct correlation between your time horizon and your entry and exit timing. So if you're trading the long-term major trend, there's less risk with longer-term trades, but with the shorter term, you want to make sure both systems are on the same side. So what this enables you to do, the combination of the 2 systems, is to trade with the trend instead of try to predict where the trend's going to go. And again, that's been really important lately because the trend has been down and the markets are way oversold. Everybody's been looking for a rally for the last couple months, and it just hasn't materialized. So these trends sometimes can last a lot longer than you would imagine, and that's why it's better to follow a trend-following system than try to guess where the bottom's going to be and trying to jump in when the market is still in a downtrend. Now here's an example of the short-term system. I downloaded this chart from Yahoo Finance. This was as of September 15th. And this is for the Russia ETF. And this red line right here is the 50-day moving average, EMA, exponential moving average. And the green line here is the 100-day exponential moving average. And we can see that the 50-day crossed below the 100-day. That looks like in July of this year. And of course, that's a short-term sell signal. The 1 month and 20-month EMA were also on a sell signal. So what this allows you to do with the shorter-term system is to go short at this point because both systems were in a sell signal. Russia ETF, right now it's trading around $14. Sell signal occurred at around the $45 price, right in here. So you would have gone short at 45 and it's trading at 14. You would have prevented a 67% loss and convert that to a 67% profit because you would have gone short at that point. So now if you didn't, let's say you only take long signals, buy signals, and you're a long-term holder of this ETF, since the sell signal in July, you would have had about a 67% loss. And to make up that loss, you'd have to have about a 207% price increase just to break even. So that shows the importance of exiting your losing trades before they develop into big losers. So you always want to pay attention to this, the short-term system and the long-term system. And if you only trade from the long side, at least get out when there's a sell signal. Exit your long positions. Question?
The entry signal is a 50, 100 EMA cross.
Right.
Is that also your exit signal from that same trade?
Yes. The question is, the 50, 100-day is the entry signal for the short-term system, and it's also the exit signal also. And if the 50-day, 100-day, or if the 50-day drops below the 100-day, you get a sell signal. Then at that point, you want to compare it against the major trend. If the major trend's on a sell signal, then you want to go short. If the major trend is still on a buy signal, then you just go flat. Now here's an example of a short-term buy signal. This was in 2006. This is for the iShares Brazil. The 50-day crossed above the 100-day, indicating a buy signal, and the major trend was also on a buy signal at that point, so you could exit all your short positions and go long at that point.
When is it too late to enter that trade?
The question is, when is it too late to enter the trade? And there's no way of predicting that. The historical results that I'm presenting, that's based on the actual crossover. Now I a lot of times will enter after the crossover, but the historical results are based on the crossover. So there's no way to predict what the results are going to be if you enter after the crossover. But yes, another question.
Follow up with that. If you're already in a trend like that and you want to jump in, can you use support and resistance levels, or see how wide your moving averages are spread apart?
Yeah, the question is if you want to jump in after the signal, can you use support and resistance? And yeah, I would use those shorter term indicators to jump in after the signal's been issued, and a lot of times I'll do that. But again, the historical results are based on the actual crossover. Another question?
How often do you encounter a false signal? Let's say that you use this 50-day moving average compared with the monthly ending price or crossover, whatever, to determine the entry points. And maybe there's sometimes the crossover doesn't stay for long, and then it will reverse back, and then you get a false signal.
Yeah, the question is, how many times do I get a false signal using the 50-day and 100-day and the 1-month and 20-month EMA? And if you use both of them together, you don't get that many false signals. As a matter of fact, I think I have some examples here of the markets that are in a major buy trend, but over the same period of time, there was 4 or 5 sell signals by the shorter term, and they were false signals, but you would have just gone flat at that point, and then you'd re-enter when the shorter term goes bullish again. So I think I have some examples for you.
When you say you go flat, this means you exit the option, exit the trade?
Yes, the question is, if you go flat, do you just exit the trade? And yes, with the shorter term system, if the 50-day crosses below the 100-day, that's a sell signal. But if the major trend is still bullish, then you just go flat. If the major trend is bearish, then you take a short position. Now, what I'm presenting here is the results for the 50-day, 100-day EMA. And this is separate from the major trend system. I just wanted to give you an idea of the historical results for using just the 50-day and the 100-day EMA. And these are the Fidelity Select funds, which were the original ETF, so to speak. Most of the Fidelity Select funds were created in the 1980s. So what I did is I just did some testing of investing $1,000, the Select fund, in this case the Air Transport in 1986. This was a 20-year test. Some of the markets were tested longer than 20 years, but 20 years is about the average. The initial investment of $1,000 had a 385% return, a $3,800 profit, and a profit-to-loss ratio of 4.2. This is most of the Select funds at that time. If you invested $1,000 over that 20-year period, your total initial investment would have been $22,000, and you would have had a 1,000% return, $224,000 profit. So again, this is just the 50-day and the 100-day EMA. I just wanted to give you an idea how that's done over the past. Now here's the actual rules of the short-term trend system. And you can see there's 4 possibilities. If the 50-day, 100-day, and the 1-month, 20-month are both on buy signals, then you want to buy. If the 50-day and the 100-day is on a sell signal, but the major trend is still bullish, then you go flat. And if both systems are bearish, then you establish a short position. And if the 50-day and the 100-day turns bullish, but the major trend is still bearish, then you want to go flat. So here's another example of a sell signal. This was in June of this year for the emerging market index. And again, the 50-day EMA crossed below the 100-day. And here's a trend confirmation of that same market, the emerging markets, using the 1-month and the 20-month, and that confirms the downtrend. So you don't want to take a short position until the major trend is on a sell signal. And here's some examples to answer your question about false signals. Here's the emerging market, the longer term 1-month and the 20-month EMA. You can see right here it's in a bullish mode. But during this period, this bullish period, there was 3 short-term sell signals. But because the major trend was still bullish, you just would have closed out your position and gone flat with the 50-day and 100-day. Wait till it goes bullish again and then go back onto the bullish side. So in this case, it prevented 3 false signals by monitoring the major trend and not going short unless the major trend is short. And here's an example of the S&P. It was bullish from 2003 to December of 2007. And during this bullish period right here, there were 4 or 5 sell signals with the 50 and the 100-day. And of course, with the major trend still bullish, you'd want to go flat and not take a bearish position. So it can save you from those types of shorter-term whipsaw trades.
When you referring major trend, do you mean the overall stock market trend?
No, the major trend is the 1-month price in relation to the 20-month EMA. That's what I call the major trend. So this is a great tool to use no matter what market you're trading. This is a great tool to use. I use it for my stock trading. I won't go long a stock unless the short term and the long term is bullish, and I won't go short unless they're both bearish. So this is a great tool to use for any type of trading. Another question?
Yeah, I'm just curious if you wanted to do this on a
Yeah, the question is, can you use the weekly price instead of the monthly? Would that give you more whipsaws? And yes, it would.
I mean, even if you still use the 20 EMA, 20-month EMA rolling average, just sample more often.
You mean use the weekly chart instead of the monthly chart?
No, use the same monthly chart. It's just that instead of, accessing the chart at the end of every month, you access the chart at the end of every week. It took the weekly.
Oh, the question is, should you access the chart on a weekly basis or a monthly basis? I access it on a daily basis. Before I make any trades, I'll always look at this chart, and it'll have the latest monthly price on there as of that day. But again, the signal is not calculated till the end of the month. But I'll look at this on a daily basis to confirm the trend, whichever system I'm using, whichever market. I'll use it. I'll look at it, and you can tell right away. Right here, you can see, the S&P is on a sell signal. So if I'm going to buy Apple stock, I'm going to look at Apple stock and just see where the major trend is.
But you're not going to wait till the end of the month to get that final price.
The question is, you're not going to wait till the end of the month. The historical results that I presented, they're all based on the signal being at the end of the month. But what I'm trying to say is, on a daily basis, you can just use this as a tool. I mean, you can look at it and you can see that this is the S&P. You can see the S&P is bearish. So you can use it no matter what system you're trading, just to an instant picture of whether it's bullish or bearish. As far as the actual trend buy or sell signal, I do that at the end of the month. The price at the last day of the month.
But the crossover could have happened on the 15th.
It could have happened earlier, yeah.
You don't care about that.
Right, because when you're trying to identify this trend, if you use the daily, it could go below it, the 20-month EMA, and then a couple days later go above it. So you could get some false signals in there. So for the actual signal, whether it's a buy or a sell, I'll use the end of the month price. But on a daily basis, I'll just use this just to get a quick glance at where the market's trading, regardless of which market it is or which system you're using. Another question?
Yeah, do you put, since you calculate it at the end of the month, do you put some kind of, when you place your order, are you always buying on the first of the month, or are you putting a limit order with that closing monthly price and say, well, I'm going to get in at this price, maybe sometime during the week?
The question is, do you get in on that last day of the month when the signal actually occurs, or do you put an order in for the following week? I typically will enter after the signal's already been established. I don't watch it that closely to see on a daily basis, if I got a signal. But to answer your question, the historical results are based on entering that last day of the month. If it's a short position, if the 1 month is below the 20-month EMA, the historical results are based on entering the short position on the last day of the month. Now here's a major trend price graph for Apple stock. We can see in the 1990s, late 1990s, the major trend was up for Apple, and it crossed, it looks like it crossed around July or August of year 2000, which was pretty much the beginning of the bear market. So the major trend for Apple was down during this bear market, and it went bullish again in 2003, and then remained bullish up until about the $140 price level, and it went bearish. So if you're trading a stock, this is a good tool to look at, just to give you the big picture of where the trend is in that market. And what I did was calculated the profit results for using the short-term trend system in conjunction with the major trend. In other words, when the major trend is bullish and the short-term trend goes bullish, then that's a buy signal, and when they're both bearish, that's a sell signal. And when they're in conflict, then you just go flat. So what I did is I did historical testing on that. That has to be done manually. And here's the rules again for the short-term trend system. And here's the profit results for the Brazil index since inception in year 2000. Latin America index since inception in 2002. You can see using the two systems, there's less profit than if you just used the major trend system, but it gives you more opportunities to enter and exit in case the major trend is on a long-term buy or a long-term sell. It gives you more opportunities to enter.
Did you calculate the difference in drawdown on these using the short term versus just using the major?
Question is, did I calculate the drawdown on the short term versus the major? No, I didn't calculate the drawdown. I pay more attention to the profit to loss ratio, and if I can achieve my 3-to-1 profit to loss ratio, then that's a good indication that the system is going to get you out before you have a big loss.
Yeah.
But to answer your question, no, I didn't calculate the drawdown.
These were without commission still?
Yes, yeah, these were.
How much is the commission, generally speaking, on this ETF?
Commissions usually, I trade at E-Trade, it's usually $8 for the ETF. Okay, that ends my presentation. Any other questions?
One question here.
Yeah.
On the long-term trading plan, because the market's torpedoed this month, and let's say you bought the bear ETF, and it's sitting down at the bottom here right now, it's going to take a long time for that 1 month to cross the 21.
Yeah.
You could leave a lot of money on the table, is what I'm saying.
Yes. Yeah, the question is, with the market moving down so far, so fast, it's going to be a while before it reverses and goes long, and you're going to leave money on the table, and that's correct. In the meantime, you've made a lot of money on the downside, so I'm just happy with that. So.
But you wouldn't get out if there starts to be a rally. You wouldn't cash in that short ETF.
Well, the question is, would I take profits on my short positions if before there's a buy signal? And the answer to that is yes. I would take profits on part of my positions, but I would always keep part of the short positions on until they reverse. But to answer your question, yes, I'll take profits on part of my positions because that's just good money management. I mean, if you get pretty far ahead, with the way these markets are, you definitely want to take profits. I usually do it in increments of 3 to 4 increments. In other words, I'll buy at 3 or 4 different price levels, and I'll also sell at 3 or 4 different price levels. And that way, I lock in profits. Now, that doesn't apply that much to the option spreads because those are better if you just maintain the spread till expiration because you're taking advantage of the time value of the short option. So with the spreads and the covered calls, I may hold those until option expiration. But if I just have a bullish or bearish position on, then I'll sell some of that if I get some profits.